Okay, good evening, everyone. Thank you for joining us today. Today, we are honored to have CEO of Lendlease and the CEO of Fireside Hospitality Trust, Kelvin and Gerald, with us. So they'll be joining us on the Fireside Chat later after the presentation. So yeah, I'm Darren from Phillips Securities Research, and later during the Fireside Chat, Paul will be the moderator. So yeah, so without any further delay, let me head right into the presentation on the S-REITs outlook with a focus on hospitality and retail. Sorry, it's lagging. Okay. Yeah, so this is the S-REITs performance year to date. As you can see, the commercial subsector is down 2.8% year to date, while the better performers are the industrial, healthcare, and the diversified. So the industrial subsector came in, the year-to-date performance is at 5.9% as of last week, probably because of their very strong FY22 results, while the commercial sector were weighed down heavily by the US office REITs. So the US office REITs, they came out like there are a lot of bad news in the US office sector, especially in the gateways, those with gateway assets. So that was why there's a sell down in commercial for the S-REITs. And this is following from the returns that was negative about 17% for the S-REITs for the full year FY22. So this webinar has a focus on the peaking of interest rates. So as you can see in this graph has some of the key interest rate references here. As you can see here, this is the Fed rate. This is the line in gray, and then the US 10-year government bond. And this is the Singapore, the swap offer rate, the 3-month fixed. And this is the Singapore government bond, the 10 years. So as you can see, in FY22, interest rates shot up, as you can see at this right side. And then right now, we see that the bond yields, a lot of them are like flattening out, or they're even inverting. Of course, in 2022, the rates were keep increasing, so a lot of the REITs were taking a more of a wait and see approach rather than they can fixate any strategy going forward when they know that the rates peak. Yeah, so this slide is the S-REITs yield spread over the Singapore government 10-year bond yield. So right now we're towards the right side here. As you can see, last year the yield spread was trading about over minus 2 times standard deviation from the 10-year average. So right now, the yield spread is actually going back up. So how do you read this chart? Is actually if the yield spread is up above the average, is a good sign, meaning that investors are compensated more. They are being compensated a higher yield for investing in REITs over the so-called the risk-free 10-year Singapore government savings bond. So right now, as this chart moves back towards the historical 10-year average, we think that it might be a good time to start investing in REITs again. And from a tactical standpoint, we are also quite bullish on REITs as compared to the rest of the market, because there are a lot of uncertainties in the market going forward, and a lot of investors, they would like to invest in REITs. Like they see REITs as a safe haven and as compared to some of the broader equity market, and it's a very it's more of a safer play compared to like tech shares, for example. So this chart is actually the S-REITs price to book, the valuation chart. So as you can see here, the left side is the price to book, and on the y-axis is the price to book, while the x-axis is the dividend yield. So how do you read this chart is, on the top left-hand side, for example, a Parkway Life REIT is trading at over 1.5 times price to book, and they're trading at a yield of about 4%. So this is considered expensive as compared to perhaps the US listed REITs, where they are trading about 18% dividend yield, and they are trading about 0.5 times price to book. So this shows that some of the US REITs, they have some of the overseas REITs, like around this circle, they have priced in the risk going forward. While a lot of the local REITs with assets in Singapore, a lot of them are trading around this central area, around the 1x price to book and about a 4 to 7% dividend yield. So our guests today from Lendlease and Fireside, they're also trading around the center here. So Fireside is here and Lendlease is here. So this is in line with a lot of the other REITs that are trading with Singapore assets in the market. So this chart, it shows the sensitivity analysis of a 1% rise in interest rates. So this chart shows, like, for example, if you're unhedged fully, a 1% rise in interest rate will affect your DPU by 8% if you're prime. So this and 70% for CapitaLand Escort. So these companies, or rather these REITs, they were chosen just randomly as a proxy to the broader REIT market. So there's no particular reason why these REITs were chosen, but we chose some of the REITs like from different sectors like FCT, from retail and prime US office and data center, industrial, etc., etc. So from what we see here, it's very important that the REITs are hedged, as the Singapore, the average REITs hedging is about 70 to 80+%. So most REITs are around that levels. So you can see prime US REIT, they are 80% hedged, and 100% basis point rise in interest rate will affect their DPU by 1%, while for CapitaLand Escort is 3%. So however, if they are not hedged, they'll be affected by 8% for prime and -17 for CapitaLand Escort. So this is tricky because going forward, when interest rates peak and perhaps start to reverse course and start to go down, if you are too hedged also, it's not a good thing because you're kind of locked in the high interest rates, while actually the floating rate is going down. So it's a very tricky situation to be in going forward, whether you're hedge or not hedge your interest rates. So I'm sure our two guests will be happy to share more about their strategy going forward. So for hospitality, this graph shows that there's strong RevPAR recovery since the COVID era, and while visitor arrivals are still quite low. So how do you read this is the red line is basically the pre-COVID until here, January 2020, there was a sharp drop. So this sharp drop is, of course, based off due to COVID, and then for visitor arrivals, it was almost zero. So when these levels, so it was around these levels for about 1 year, and then it started to recover as the borders opened up in 2022. So right now for the visitor arrivals, it's still negative 43% from pre-COVID January 19 levels. However, RevPAR, of course, when COVID struck, it dropped, but it recovered strongly, and in the middle of 2020, it already recovered way higher above pre-COVID levels. So right now, as of January, is trading at 5% of pre-COVID January 2019 levels. And we see this drop from the highs from December because it's basically seasonally adjusted. Like in December, it's a holiday season, so of course many people are traveling more, and because of the strong demand, and especially back in October there was F1, so that's why there was kind of a spike in hotel RevPARs. But then in January, because it's not really the season for travel, and that's why the RevPAR probably dipped a bit. But no doubt but regardless, it's still above pre-COVID levels. So we believe with the reopening of China, although a bit slow, but towards the second half, as the Chinese tourists start to come in, we believe that this RevPAR will maintain stable or even start to increase or continue to increase further. So this graph basically shows the international visitor arrivals by inbound tourism markets. So the theme of this webinar is actually return of China's travelers and interest rates. So this is one of the themes. As you can see, pre-COVID, Chinese and Indonesia is this blue color over here, and China is a red color here. So you can see pre-COVID, they are around the same number of visitor arrivals from these two countries, both Indonesia and China. But right now, China is still like almost negligible as compared to Indonesia. So Indonesia has recovered, but it's still not at pre-COVID levels. So going forward, like we believe that the return of Chinese travelers, it will take some time. It won't be so fast, but perhaps towards the second half of the year, we expect this to pick up. I'm sure Gerald from Fireside Hospitality, he can share more on this later. So this slide is actually just retail sales, and right now retail sales are 12% of December 19 levels. So retail sales, of course, during the COVID circuit breaker era, that was that for that 3 months, the retail sales crashed. But then it slowly recovered, and for the whole of last year, retail sales were above pre-COVID levels. So we believe retail sales can continue to remain strong, even though there are some headwinds like the rise in GST from 7 to 8%. All these are slight headwinds for the retail sales going forward. But we believe they can maintain quite relatively stable above pre-COVID levels. I'm sure Kelvin can share more on this later. So with that, I hand over my time to Paul. Thank you. And you start the fireside chat now.
Okay, thanks thanks Darren. Thanks everyone for joining us here today. I think, but let me just reintroduce, just in case some that came in later. So we're extremely grateful and very privileged with us here today, two REIT CEOs that will discuss the current operating environment, especially in retail and hospitality. And like the topic suggests, peak in interest rates. So we have here with us today, with us today, Mr. Kelvin Chow, CEO of Lendlease Global, and Mr. Gerald Lee, CEO of Far East Hospitality Trust. So the agenda is now I'll be posing some questions to our distinguished guests until maybe 8 p.m. Then we will then move on to some of the questions from the attendees. The questions are actually coming from our REIT analyst, Darren. I think my role is just to read them out. I guess I'm like the opposite of ChatGPT, neither intelligent or neither artificial nor intelligent. So do feel free to type in your questions in the Q&A tab at the bottom, and I will just read the questions out at 8 p.m. So let me just start with the first, since it's all about interest rates right now. So I'll pose this question to Kelvin, then maybe Gerald can also follow up. So the first question, the Fed has just raised interest rates by 25 basis points last week. So what is your outlook for funding costs going forward, especially with the recent banking crisis? And I guess what has been the discussions that you may have not been having with some of the bankers right now? Thank you.
Sure. Thanks. First of all, thanks the audience and also Phillip for organizing this event. Interesting one, and we can surely share some kind of information or share some of this insight that we have in our operations. Okay, to your question is that basically when we meet up with banks, I think it's still of course the overall interest rate is actually at moving on a higher side, given that Fed continue to hike its interest rate. But I think surprisingly, when we talk to them on the margin regarding to the rate or how we actually sort of like forward hedge our position, actually the margin is actually lower than what we have. We believe due to a few reasons. I think one of the obvious reasons is that the rate actually has increased in size. I think previously when we have deal, I think we have only like 1 million.
Sorry, Kelvin, I think your audio is a bit soft. Apologies for that. Yeah, sorry. Yeah.
I will mess it up. Is it better now?
Yes, thank you. Yeah, thanks, Kelvin.
So maybe I get back to the answer. Okay, what happened is that on the earlier we went IPO, we only like this size is only around 800 million. But after we acquired GEM, we moved from 800 to 1.6 billion. So from the bank perspective, they look at overall portfolios, so whether the asset is actually healthy or not. So they actually provide us with a lower margin compared to what we have on the initial, when we actually sort of try to lock in the loan facility. I think that's a good thing. Although the interest rate is increasing, but I think on the margin part, it's lower. So as to how I foresee the future funding costs will be, of course, that is going to be $1 million questions, which of course it's very hard for me to give you a forward-looking kind of statement also, given that SGX will kind of for me to sort of question me, of course. But I think one of the things that I can actually share with you and put into perspective for you to actually analyze REIT is very simple. Because for REIT, basically you put into two components. One component is our investment in Euro, which is our free asset in Milan, and the other portfolio is our investment in Sing dollars, which is basically make our GEM and Q13. So how you can actually look at our portfolio and how you think we can actually sort of combat or actually work against the higher interest rate is as such. Okay, for example, if you look at our latest announcement, you notice that our Euro asset has actually increased by 4.3%. I think that is in our announcement. And if let's say you believe that Euro generally the interest rate has been increased by around 2%, that means the net position that we have actually is a 2.3% of uplift or increase in cash flow from distribution. And basically, for our Euro investment, it's a triple net arrangement. And it's basically what it means is that we will not need to pay for the cost of the operations. We just collect the rental, and the rental we receive from the tenants is fully distributable to the unit holders. And basically, there's no withholding tax because it's structured in a way that is very efficient, very tax efficient to the unit holders. So from that perspective, the unit holder will not suffer any kind of cost for that, and we will only enjoy the annual increase of the Euro dollars rental. So I think that's the beauty of it. This year increased by 4%, and the coming year, which is I think by the coming April, there will be another increase. So the rental will continue to pick up. And if let's say we fix the cost of our rising interest cost, I mean, you look at the delta, the increase is 2%, right? But our rental increased by 4%, right? Then it itself has a net positive impact of around 2%. Okay, that is on the Euro dollar investment and Euro dollar cash flow. On the Sing dollar cash flow, if you look at it, I think from our IPO to now, probably the interest rate increased by around 3%. But not forgetting, we are actually 2/3 of our interest, 2/3 of our loan is hedged. So in that case, the effective increase is only 1%. But on our announcement, we actually make it very clear that most of our leases has this annual escalation of around 3% So again, the net positions that you can look at is also 2% increase. So from that perspective, I think if you just look at the delta, the change between the early interest rate to our current interest rate environment and our revenue earlier into the current, I think you will probably appreciate that. I think we certainly can able to combat with the rising interest rate, and also I think with our positive cash flow, I think we will certainly be able to manage the situation.
Yeah, thanks, Kevin. But I think your audio is it swings. I think sometimes it's a bit soft, sometimes it's a bit loud. So I'm not sure. I think we did a technical check, was fine. I guess it's like Murphy's law kind of situation.
I don't know whether if I were to turn off the video will be better. Sometimes it could be due to the.
Oh, okay, sure. Yeah.
But we will try and hopefully improve. Yeah.
Okay. Then in the meantime, we'll let Gerald do all the talking then. So, Gerald, the same question. I mean, Fed raise rates now. What's the outlook now as you have discussions with the banks? Yeah. Thanks.
Okay, thanks, Paul, and good evening, everyone. Thanks for joining this seminar this evening, for taking your time over your dinner to listen in to what we have to say. This question about the rising interest rates, I think, of course, is everyone's concern because it does affect us on two fronts, which I will address. One, of course, is in terms of the cost of our debt and how it flows down to distribution. And then the other impact is in terms of potential acquisition that will impact the growth of our trust going forward. So I'll take the first one first in terms of the potential impact of the higher interest rates in terms of our distribution. On this front, must first of all bring us back to what we were quite fortunate to have achieved at the end of 2021, about a year plus ago, in that we managed to divest Central Square, one of our properties, one of our 13 properties, for $313 million. And today we just make an announcement that we receive an additional $18 million in incentive fee because the acquirer managed to fulfill the condition as per our contract. So all in, we had achieved about $330 million in terms of proceeds from this divestment, which we had used a large part to pay down our debt, which today stands at about $700 million. So our gearing was about 41% prior to the divestment, and today is standing at about 32%, and that is before the $18 million. So I think in terms of our balance sheet, we are in a good position. And also following on, resulting from the gains, because we have made $100 million in gains from this divestment. Our board has also committed to distribute $8 million a year in terms of capital distribution to reward unit holders, and that will go towards cushioning the potential impact or the impact that we have already faced in terms of high interest costs. So, for example, at the end of last year, our average cost of debt was 2.2% for the whole year. This year, with the higher floating rate, we expect it to go above 3%. Fortunately, we had about 50% of our debt that's been fixed, and the rate that we fixed it was pretty low. Excluding the margin, it was maybe somewhere between 0.5 to 0.8%. So if you add a 1% margin, so the average cost of those fixed debt would come in at perhaps about 1.5 to 1.8%. Then blended with the floating rate, this is where you'll take us above 3% this year that we expect. So the increase in the debt cost, possibly in the region of, for us, maybe potentially $6-7 million, I think will be fully cushioned by the $8 million in divestment gains that we'll be sharing with unit holders. So in a sense, we do expect interest to be high this year compared to what we enjoyed in the last 2 years. But fortunately for us, we managed to strengthen our balance sheet, pay down our debt, reduce the overall interest costs, and at the same time with the divestment gain, help to cushion the increased cost such that our distribution income would not be impacted. Just as an illustration, in terms of where we were at the end of last year, for the distribution income, if we did not add in the $8 million of capital distribution, it would stand at about 80% of the pre-COVID level. It was about 80% of the 2019 level, and when we added in the divestment capital distribution, it helped to bring it up to about 88%. So what I'm trying to say is that there's still some room as well in terms of the operating results for us to improve further to get us closer to the pre-COVID level. And that operating performance improvement would also help to cushion the potential increase in cost of interest for us. So overall, on the two fronts, one in terms of the capital distribution, sharing of the gains. Secondly, in terms of better operating performance, which we're expecting with the recovery of the hospitality industry this year, I think this too will help to mitigate the increased cost of interest. So that is on the first part of the question in terms of the impact of high interest rates. Secondly, in terms of potential impact on acquisition, obviously with a higher cost of debt, it will make it more difficult for us to acquire because the yield that we expect from the property would have to be higher than the cost of debt, even if you debt fund the whole property. Or if it's blended with equity, the two added together would also be at a higher level compared to what it was years back, for example. Which means that there will be few properties that would be eligible to make it view accretive for us in the market. For us, currently, our portfolio is all in Singapore. Singapore will remain the key market for us. It's the mainstay for our focus. And in this respect, we're fortunate that we have a Far East organization as a sponsor with a pipeline of assets. So we have a healthy pipeline of assets, and Far East as a sponsor, they currently own, together with concerted parties, about 60% of FPHT, which means that they are in a position to be able to offer a good price to us, because ultimately they will still end up owning 60% of the trust, even if they sell at a discount to us. And they've demonstrated in the past that they're prepared to do that. And either by taking a price that is closer to their cost price, or by selling to us at a lower lease number of years of lease, which would then make it more affordable for us. So, for example, instead of buying a property that has a balance of 90 years, in terms of a land lease, you can buy at say 65 years, and then the price reduced by maybe 15-20%. That will make it more appealing. So I think in this environment, I think this will be the option for us. Certainly, we're not rushing into buying anything right now. More possibly in the second half when interest rates stabilize a bit more. And then potentially, we'll also look at whether there are opportunities in the foreign market that have a better spread between the yield of the property and the interest cost, right? So things like this, we will have to explore in order to continue to see how we can grow the portfolio, especially with the proceeds that we gain from the investment.
Is there any particular, Gerald, is there any particular country that sticks out right now, like where you can get this positive carry or something?
I think of all the developed markets which we are looking at, first of all, for us, we do not look at developing countries, which would mean that we exclude all the Southeast Asian countries. And in terms of developed markets, where the sponsors have already gone into, that will include Australia, UK, Japan. In Australia and UK, the interest rates are also very high. With yields that are only marginally above. So for the time being, we're also not looking at those because it doesn't make sense. That leaves us in the third market, which the sponsor has already gotten a few properties there with Japan, where potentially in terms of the NOI yield, it's still possible to find something that is close to 4%, for example, in the key cities, with interest costs somewhere maybe between 1 and 2%. So there's still a positive spread in Japan.
Thanks so much, Gerald. So thanks. I'll hand it over to Kelvin on again the similar topic, which is asset recycling. I guess just wondering, are you expecting any change in sentiment, and has your strategy changed in terms of asset recycling in this environment? But albeit at the same time, REITs might be peaking at the. Thanks, Kelvin.
Okay, can you hear me better? Sure. Yeah, I just want to test it.
It's a little bit soft. Sorry. Yeah.
A little bit soft. Oh goodness.
Yeah. Okay.
Okay. It's still soft, right?
It's better now. It's better. Yeah.
Yeah. Okay. I think for us, basically, we are very conscious of what we're going to buy going forward. As you rightly pointed out, the interest rate environment is actually high. So I think anything that you actually trying to bring into your portfolio will certainly be challenging, and you could certainly be also locked in at a very high rate. I mean, due to the interest rate environment, and it's also quite challenging to be honest. That I mean, if let's say any kind of asset that actually can give you that kind of premium, it also means there will be some, it could be some underlying issues going on with the asset. Because I always emphasize that when it comes to opportunity to acquire, you always have to look at the underlying cash flow of the asset, which means you have to peer it out and look at the tenant, whether it's a good tenant, whether it's a good cash flow, or is it a troubled kind of tenants that eventually might just vacate the building, and then you lose your cash flow to be distributable to the unit holders. I think so. And fortunately, of course, I mean, given that we have just acquired Gem somewhere last year in April, so I think we have a lot of things to sort of to improve our distributions. I think, for example, I'm not sure whether the audience know that we have this inbuilt of rental escalation, as I mentioned earlier, about 3%, and in this actually to most of the leases. So it simply means that if you, without doing anything, we are able to have this increase in cash flow distribution to the unit holders. And GEM itself has a lot of future potential to improve on the ops cost. I think as what you all have shared in the slide earlier, you all have mentioned that the sales of the malls generally has improved by around I think 19% or so. I think for us it's about 20%. So what it means is that the ops cost for the mall has actually reduced. So what is ops cost? Basically, ops cost is the rental that you charge to the tenants divided by the overall sales number that they have. So technically, it means that they actually operating at a lower number now, which compared to the market average, probably you have I mean, which there are actually there's room for us to actually grow on the rental charge to them in order to make it up to the average. So I think that is an opportunity for us to also actually have a good way to catch up with the renter and also improve our cash flow. So first of all, that means first we already have the inbuilt of rental escalation in the lease. At the same time, we have this potential to increase on the rental due to the lower ops cost that we have. So I just give you some color to that. And also, I mean, for those that actually understand or know where GEM is, you will certainly agree with me that there's a lot of development surrounding the GEM, which will again were able to help to improve the footfall and also the sales number. So GEM is what we have acquired last year. So I think what we are trying to do is seriously to look at how we can sort of unlock the values and how we can sort of from the GEM and how we can improve further to on the cash flow from GEM and then have a better distribution to the unit holders. And to that, we believe that the higher footfall will also means that we can command even a higher kind of rental going forward on the reversion. I think that is something that we are looking forward to. And also, I don't know, you know about 313. Well, we are not acquiring, but we have actually abilities to increase on the net lettable area because government has given us some free additional plot ratio, which then help us to actually increase on the net lettable area. I mean, we have yet to deploy around 10,200 square feet of that into the mall, which means is that once we deploy that, it's an additional cash flow to the unit holder without incurring any kind of cost to it. And all this has not been factored into the distribution. And if we add it on to the distribution, certainly our distribution will be higher. I think that's my view on the asset recycling.
Yeah, thanks. Yeah, thanks, Kevin. Now, I was actually more looking forward to when you're Live Nation, so can go listen to some concert.
Yeah. I think the Live Nation certainly is really a kind of arrangement between us and also the authorities. And we are actually working towards finalizing some of these agreements and how we want the site to be eventually look like and how entertaining it's going to be. It's going to be interesting, and we expect it to be somehow ready, I think, once we get all the approval from the authorities. It's a very interesting site, and maybe without sharing too much is that but I just want to share with you the role of Live Nation. I mean, I don't know you understand is that, for example, you go to a concert, basically there's a venue operators and also an event organizer. It's a separate role. That means the event organizer will go to the venue operators to say, I need your venue. But the venue operators might not have event every day because they are not the event organizer. But Live Nation is a different arrangement. Live Nation, basically, they will be owning the venue. Of course, we lease to them. I mean, we are the master lease. We lease them the venue. At the same time, they are event organizer. So what do it mean by that? It means that the event organizer, in order to maximize the profit, they will organize as much event as possible so that they can make a very good profit out of it. And we did actually talk to Live Nation. So roughly how many events you can do if let's say you want to max out a day kind of event? They can say that they can turn around easily 4 to 5 events for a day, and the capacity could be as high as 3,000 to 3,500. So in that case, you can imagine the footfall, the incremental values that can add on, the synergies that we can generate from there. And Live Nation is fully responsible for a site. So to our unit holders, we are actually coming 0 cents. I mean, literally $0 for the site, and then Live Nation will just build it up at their own cost.
Thanks, Kevin. Yeah, I'll call you once it's on for the tickets and so forth. Yeah, but anyway, because sometimes it's so hard to get tickets. Yeah, so hard to get tickets actually. Yeah, sometimes for some events. Yeah. Okay, come. Let me just take on one more final question on interest rates. I think we have too many questions on interest rate. So this is just the final one. After that, we promise to mention the word interest rate. But the last one is like, how do you decide on taking on the interest rate hedge, and then what criteria is the most important in your opinion? I hand it over to Gerald first, if you could, Gerald. Thanks.
Hi, Paul. Yes, I think it's for us, we take a very pragmatic approach in terms of hedging policy. We also do not go for a very high ratio because we want to be also while keeping a good balance of proportion of fixed versus floating. We also do not want to overpay in terms of going for interest rate hedges. So, for example, right now we are at about 50% fixed with interest rate swaps, and we'll continue to monitor going forward. Obviously, right now, if you go into any IRSs, you'll be at a high price. So we lock in when the rates were low. So some of the hedges that we went in, the rate that we locked in was maybe averaging about 0.5 to 0.5 to 0.7%. So that was a good time during COVID. Right now, if you have to go in, I think the rates that we have to fix will be easily in the 3% region. So we will not want to do that, but we will continue to monitor the situation until such time when it stabilizes a bit more. And then also taking the overall cost of debt into consideration, we'll decide how much to go for and for what tenure. We are also exploring other means of refinancing our loans such that we are able to contain or even save some basis points in terms of the cost of debt. For example, one arrangement that we are looking at right now is in terms of a cross-currency swap between US and Singapore dollars, which can potentially save us 30 basis point or 0.3% in terms of interest cost when translated back to Sing dollars. With everything all fully hedged in terms of the interest payment every quarter, as well as the exchange of the notional at the beginning and the end. So things like that, that where there's opportunity for us to save on interest costs, we do so, other than making use of interest rate swaps as a way of hedging our interest costs. Fortunately for us, in line with rising interest rates, we also seeing better improvement in terms of the operating environment. So ours is quite dynamic in the hospitality industry. For the hotels, the leases are very short, in the 1 to 3 days basis. For the service department, it's a bit longer, 1 to 2 months on average. So we are able to reset the prices where necessary to go along with the higher both interest cost as well as inflation. And travelers, in a way, and with the market is responding as such, I think the travelers, in a way, especially the corporate travelers, they will understand. And this what we are seeing in terms of the average room rate in Singapore as well, that it has gone up in general. And even for the last quarter of 2022, the rates were not even much higher than what it was in 2019. Not saying much higher, but I think it's about maybe 20% higher than what it was before for the last quarter of 2022. We don't expect it to stay elevated all the way and continuous increase, but I think that the higher rates will have to mitigate the increased inflation as well that we're seeing.
All right, thanks, Gerald. Same question, I guess, Kelvin. I think probably like a year and a half ago, probably nobody talked about hedging, but I guess it's a hot topic now. So just wondered your perspective, Kelvin, on your interest rate hedging strategy.
Yeah, actually, I totally agree with Gerald. Is that I think we continue to take a prudent kind of capital management approach. At the same time, maintain some flexibilities. To be honest, I think fully hedged position doesn't mean that you are safe, but it just means that you have less flexibilities. So for us, is that we want to have the flexibility so that when we do our whole and divestment analysis, we know that we can actually have a way to sort of like move out of the asset so that we can technically, as you said, recycle, but doesn't mean that you have to do it at the same time, because you can sell it first, but you hold to the cash. That's what Gerald has been doing, and then maybe do a purchase later on. I think that is something that you can do if, let's say, you are not fully hedge your position, and we believe in that. So in that case, we'll continue to hedge, of course, higher, more than 50 certainly, but but maintain the flexibility. I think everyone has been trying to focus on a lot on interest rate, which of course is not wrong to do that. But I think one of the things that I think that has been missed out is that how you actually improve all your cash flow in terms of qualities and in terms of how you can sort of future-proof your cash flow. I think that is more important than addressing the interest rate, because at the end of the day, interest rate is just, if you 40% hedge, it's just 40% of the issues that you have. But if you improve 100% of cash flow, actually you actually do more than what is increased about, and then you can actually sort of improve on your performance and distributions. I think 3 things or rather 4 things. I think probably I think as we look forward and how to address the interest rate, we can sort of re-examine ourselves. I think one thing is that maybe if, let's say, people of like have a worldwide exposure, really have to re-examine the country that you invest in, or the country you potentially wanted to invest in. Is it in the right shape? Is it in a good shape? And whether you should continue to invest in that, or whether there's the policies is actually supporting your growth going forward. If it's not, maybe it's the time for you to actually consider divesting, or maybe shift your capital to some other countries that is more stable, has a more clearer visions, and future-proof yourself. I think secondly, I think is that re-examine your assets, whether asset is able to perform or not. That's what I meant by flexibility. If your asset cannot perform compared to current return that you are talking about, I think then in that case, you might actually consider divesting it, so that in that case, you can actually improve on your portfolio going forward with a more quality kind of assets into the portfolio. I think that is something that is the second point. I think the third point is really re-examining your cash flow. I think the cash flow means that what is your underlying tenants that actually sort of fulfill your distribution obligations to unit holders. I think, for example, during the COVID, a lot of tenants actually go bust because they can't support the operations. They don't have, like, for example, omni-channel kind of operations to reach out to the customers, and they suffer because their business have to close physically, and that's it. They can't do anything. But fortunately, I think we have already sort of looked ahead of this kind of issues, and out of our portfolio, about 2/3 of our tenants actually has this omni-channel strategy in the operation. So when it comes to COVID, they are able to actually sort of address to different ways to meet to reach to the customer. So in that case, they still have the continual cash flow to support the operation. They can still continue to honor their rental. I think that is one of the few good reasons why our aging, even during the COVID, actually is quite healthy, because we maintain a very good profile of the tenant. At the same time, they offer very relevant kind of services and products to our unit holders. So this is the third point. I think the fourth point is that always, under this sort of crisis, look at your balance sheet, whether your balance sheet is able for you to survive through the crisis or not. The thing is that, yes, it's good that you continue to produce a very stable kind of distribution, which I think all the CEOs certainly want to do that, so that the unit holder is happy. But if you are having issues that you think you are difficult to move forward, I think that's where you have to make some conscious decision how you want to manage the cash flow in order to balance your situation. I think that is the things that I think that as a unit holders, or rather as a CEO or as a management, they have to seriously look at it and re-examine it. But I think, fortunately, I think we constantly look at the balance sheet. And we believe that we still have the strength to actually distribute healthily to the unit holders without any disruption on our distribution pattern. I think that's how we're looking at it.
Thanks, Kevin. I guess some also manage their cash flow by not paying perpetuals, but that's another topic. So let's not go there. But so in the meantime, For the attendees, so feel free to post any questions. So we will start trying to address some of the questions by 8 p.m. Now, feel free. The Q&A tab is slightly at the bottom of your screen. Also, feel free to type in, and I will just read all the questions out. Okay, so enough of interest rates again. Let's not go there anymore. We have enough of questions on interest rates. So let me just move on to, I guess, the other hot topic, which is China. Let me just pose it first to Gerald. Like how much did Chinese travelers contribute to your properties pre-COVID? And when do you expect this to normalize? Maybe is there any indication from your forward bookings and what's driving the pace? Whether is it slower or higher than expected? Yeah. Thanks, Gerald.
Okay, hi Paul. Believe it or not, we do track the nationalities staying in our properties. And we have actually more than 100 different nationalities staying with us. And China, pre-COVID, contributed about 20% to the Singapore visitor arrivals, or about 3.6 million arrivals a year in 2019, which means it's about 30,000 a month in terms of arrivals. Even during the pre-COVID days, we do not receive more than 10% of Chinese guests in our properties. So we are very diversified. Of course, out of 100 nationality, maybe what will be of concern to us would be the top 20, top 30. And this will include countries like Australia, Indonesia, even the European countries like UK and US, Japan, and so on. So China, on its own, did not contribute more than 10% to our guest profile. Right now, as a whole for Singapore, we are only receiving about 1/10 of what we used to get pre-COVID, which means that if you look at the February number, Singapore only received, instead of 12,000 a month, we only received 35,000 in February. So that was slightly more than 10 what we used to get. And likewise, that filtered down to our guest profile as well. We are not getting too many Chinese, although we still have some, but and in the past it could be close to 10%, somewhere in the high single digit, and now it's in the low single digit. So fortunately, we're able to get contribution from the other countries that help to make up for the guests in our properties. And for China, if we look at what is going on in the market right now, I think a lot of flights have not gone back to where it was before. Many flights are still not being mounted. I think partly due to the tightening on the China side by the authorities to control the outflow of people out of China. And also they are doing it by way of not granting visa as liberally as before for outbound travelers, and also for tour groups. So we see an absence of tour groups in Singapore from China. I think all this we expect to change in the second half, because the government, first of all, our government is lobbying, and we heard about Dr. Vivian going to China to ask for more landing rights for airlines to fly into Singapore. There's some marginal increase. And then also, I think after some time, the first wave will be the corporate travelers out of China, and then after that, the rich individuals, the FITs, those with connections to get visas, and then finally, the tour groups. So we do not expect it to come so soon, not in the immediate 1-2 months, but more likely in the second half of this year. And for us, I think that, and for Singapore, it's good that we are an attractive destination with very diversified sources of arrivals, both for business travelers and also for leisure travelers. So in the past, before COVID, Singapore used to get about 1/3 of our arrivals being business travelers, and another 2/3 being leisure FIT travelers. Right now, the proportion is more a higher proportion of corporate. It could be maybe around 50-50 at this point in time. So we haven't fully seen the full return of all the leisure travelers, China included, which means that we are progressing along. It's a better environment than what we had a year ago, but it's still some way before we have a full recovery. So we need somewhere by the end of the year, our after it collects 90%, if 90% growth, and if we are fortunate, maybe closer to 100% of the pre-COVID. So I think it's a slow progress stepping up. While in the meantime, I think what will help by is the higher rates that we are getting right now compared to what it was pre-COVID. Part of it is market dynamics, where with higher inflation, etc., the hoteliers are also putting in higher prices into their rooms. And secondly, also due to some of the initiatives that were undertaken in renovating some of our buildings during the COVID period, and also rebranding them as a result after the completion of some of the refurbishment. So we have a service residence that we have rebranded, Regency House Adina, with some light refurbishment that we have undertaken. Likewise, the Elizabeth Hotel that the product was not good, and we used to only get tour groups largely. And for example, as an illustration, the rate we used to be able to command was somewhere in the mid 100, maybe say 150. But after the renovation that we just had, we opened it at the end of last year, the rates that we are going for right now is above $200. So as a result of some of this rebranding, some of the product enhancement, some of our other properties, we are able to command a higher rate that can help to mitigate both the lower volume that we are seeing right now, and also to better the higher cost of operation.
Thanks, Roger. I just wondered if was there any particular nationality or country that if you can recall, like the last few months that's been doing particularly well, or there was nothing unusual?
I think Australia has come back quite strongly, and likewise Indonesia. And then of the Southeast Asian countries, I think like Vietnam, Philippines, to some extent Malaysia. So maybe the laggard would be some of the Northeast Asian countries, especially those related to China, Hong Kong included. Japan, I think, has also come back in some way, although they were quite slow in reopening. So I think they only reopened in October last year, which means that before that, it was also a bit more troublesome for Japanese to get out. So I think we expect the Japanese also to recover more strongly this year.
Okay, thanks, Joe. I'll pose the same question to Kelvin, but I guess it's a bit unfair because it's a mall, because you won't know. I think it'll be a bit worrying if you know who are the nationalities that walk into your mall. So I'm just wondering, like, whatever you can share, what's the impact for Chinese tourists before and thanks.
Yeah, I think it's a very good question, which of course I can't be as elaborate as Gerald, given that I think nationalities and how that has been deployed to the revenue relatively relevance for them compared to us. I think while we do actually have a mall at in the middle of Orchard Road, right? We don't actually rely too much on the international travelers. I mean, we look at the statistics, we only probably close to around 16% of our footfall is made up of the travelers. So I think that's why, while there's some restriction on travelers and all those things, our local market and domestic market actually support us quite well in terms of achieving our sales numbers and also achieving a footfall. I think I saw one of the questions is asking what is the sales number that we have, and in GEM and 313. I think in totality, I think we do actually report in our this latest quarter number is that we already above our sales number by over 20% compared to pre-COVID. So it means again, I emphasize again, the RevPAR is low. Of course is low. That means you can certainly be able to see very good momentum of rental reversion. I think that's one of the things. And also our target audience for the Orchard Mall, which is 313, is more on the youth and young professionals. And these are people that also are technically very loyal. I mean, if let's say they find that you continue to provide them with the relevant services and product and offerings, I think they're happy to go to your place again and again and again. I think that that is something that we find that is encouraging, and we keep innovating on our offer and product mix, so that in that case to continue to draw their attention. So you understand that when we look at the lease renewal, we don't usually look at very long leases to the retail tenants because we want to also sort of like understand what is the product, whether they get tired with the consumer. That's when the consumer don't feel that the product will, continue to be relevant, or they don't really like the product. So that's when we always look at a shorter tenure. Of course, 3 years usually the norm, and then to see how we can sort of improve on the tenant mix. I think that this is one of the ways that I emphasize is to improve cash flow. So it's that only when you can actually be able to satisfy your downstream customers, then there's when your intermediate, which is a tenant, is happy, and that's when you can actually increase your rental. I think that's how we sort of manage it. And managing retail asset is always very tricky. It's a tripartite kind of relationship. Actually, your objective is not to satisfy the tenants, but is to satisfy the customers. So the customer is happy, and then when the tenant becomes sticky, and that's where you can actually charge a higher rental. Yeah.
Kevin, you know what, Kevin? This afternoon, our whole department went out to 313 for lunch.
Thank you so
Wonderful.
much. I forget to give you the voucher.
Yeah. Next time can go for longer lunch in the concert. Oh, oops, shouldn't say that.
Okay.
Maybe just to add one point,
sure.
is that I think we have, despite the fact that we have not reached a full recovery, but certainly we have gone through the worst. Looking at what we have gone through in 2021, 2020 we have a few months of normalcy, and then we went to COVID. So 21 was a full impact, and then 22 we staged somewhat of a recovery, in some sense, and then 23 we should get better. So I think, of course, we were greatly helped by our fixed rent from our master lessees that provided a base. And then last year we started to achieve some variable rent. So this year it should continue on that path forward, even though we do not see the full recovery yet, including the full return of all the tourists. But yet I think it should be a better year with the year-on-year improvement until we get there, hopefully by next year. Should be the same or maybe even faster for Kevin.
Yeah, the opening, right? Just at least one more easy, low hurdle.
Yeah, let's improve the performance together.
Okay, since we hit the 8 p.m. mark, so I'll just I'll just read out the questions. I'll just go in chronological order since there wasn't any particular question with the huge upvotes. So this one is easy. It's addressed directly to you, Gerald. So Gerald, appreciate some color on the room capacity of your assets. Like I guess it's the number, and is it back to full capacity? I guess that's probably the question.
Okay, yeah, I wasn't quite clear what was the background behind that question, because capacity, I suppose, mean the supply or the availability of the rooms. But essentially, okay, if I answer it both in terms of supply and demand, we currently have like 2,700 plus hotel room, 2,745 hotel rooms, and around 240 service residence apartments. Last year, some of our hotels were contracted to the government, which means that they pay for all the rooms at a pre-fixed price. And that ran on for a good last 2 years during COVID. We have come to a point whereby the government has stood down in terms of DOSCON for COVID. So they have returned back most of these hotels except for one, which they continue to sign up for the next few months. So all the hotels are back except for one, and the service residences were not contracted to the government. They have been operating even during COVID. And so that is from the supply point of view. I suppose that is one part of the question. And then in terms of demand, the service residences continue to do very well. Very high demand, occupancy of about averaging about 90%, and rates that are much higher than before, in line with the rental market in the housing market. So strong demand for long stay accommodation, and for service residences we do have more flexibility because of our staffing. We're able to take in people from as short as 1 week to people who demand a few months because they're renovating their houses. and to people who want to sign multi-year leases because they're relocating and staying in Singapore. For the hotels, we had been operating those properties in the market without a government contract last year. We have seen the occupancy going up, some even on days going above 90%. But in pre-COVID, many of hotels are running high 80s in terms of occupancy, high 80%. So right now, I know the range will be somewhere between 70 to 80%, some consistently over 80%. So there's a range in terms of the performance because of their location, price point, and so on and so forth. And then for those properties that have been taken back from the government, we'll be ramping up the occupancy. Some off the very quick start. For others, like for example, we've just taken back the Village Hotel Changi. It's a bit further in one corner of Singapore. It's a bit more niche in terms of demand. So we're starting to get a word out to get tourists, to the wholesalers to get tour groups, and even for corporates to book residential meetings for people to stay there for a conference, etc. So those in town that we have taken back, they are off to a very quick start. For example, Rendezvous Hotel, Albert Court, and so on. So I would say that generally the occupancy is relatively healthy and according to our plan for this year.
Thanks for that. Thanks for Gerald. Move on to the next question. It's a bit long, but I'll hand it over to Kelvin for this question. But let me just read it out. The S-REIT sector has been around for a while. It seems to be running pretty much on autopilot now. Having said that, is there any innovation or new ideas in the sector to excite potential investors besides tenant incentives, AEI, prudent balance sheet management?
Wow, it's a very tricky question. Okay, I think of course, okay, given that real estate is as good as what it is, I think of course, I mean, especially for the retail, I think it's really to find your identity of the mall and then how you sort of like continue to attract the right kind of customers or right kind of shoppers to your malls. I think why I mentioned that and why is it to me is considered innovation, because for us is that, I mean, everyone will feel that hey, the physical mall face challenges with all the online shoppers and all those things. To be honest, actually that is not very significant in Singapore compared to overseas, because for us, I think mall is a place both Singaporeans will go. I think be it to enjoy the aircon, also be it to enjoy the crowd. Sometimes is to socialize, and sometimes it's also to find the right things for themselves and enjoy. Me, it's a lifestyle and enjoyment, I would say. So what we do is that, for example, 313, we find that it's very centrally located, and we want to be the incubators of new brands and new tenants that probably have this onshore to offshore kind of strategy in their businesses. For example, I believe a lot of people heard of Love Bonito, but do you know that Love Bonito started off its first shop actually in 313, and they actually is an online operators, but they actually go offline so that to service the customer better and also provide them with a more personal services. At the same time, they want to increase their sales by doing some cross-selling and all those things. So, and it proven that it's actually they're doing so well. Now they actually go into they actually in Gem and other of our competitors more. I think you can see that always, for example, I don't know you heard of 吃茶3000 and even like Tanyu, all this has been start their operation in Singapore and using 313 as the first shop to sort of see how they can grow the business, because 313 has a very strategic locations, and they also attract a right pool of crowd, which is a youngster and the young professional, which they're willing to try new things and willing to explore. And then that's when they can sort of have the attention of these people. So to me, innovation means that you actually have to understand the identities of your asset, knowing how you can sort of continue to attract your customers, and then to further explore how you can, of course, generate revenue to that extent. I think for us, I think we use I would say that fortunately we use a very good strategies. So our our occupancy continues to be staying relatively high, around 99%, 99.7, 99.5. To be honest, like GEM is always 100% occupied. 313, we always have to sort of like also recycle out the tenant, and sometimes it drop a bit, but always at 99%. Average Orchard is around probably 93. So so hopefully that gives you some color of our performance of assets.
Thanks, Kelvin. I'll pose this question. I'm not sure if you've got anything to add, Gerald. I think the question is basically innovation. I mean, it's a long question, but the question is just about innovation at the REITs. If you've got anything else you want to add, Gerald.
Yeah, I will say that, I mean, for the real estate industry, it's a brick and mortar business. So it's not that easy to say and come up with funky ideas in terms of innovation. Even financial engineering, we're quite careful with. We don't want to go down the wrong track as well. So at the end of the day, we just want to provide stable returns to our unit holders. Unfortunately, we are also battered by the global environment, especially in terms of credit risk, interest rate, and all these things will have impact on share price, especially if they need to take money out just for security and park in the bank in the meantime. Right? But having said that, I think within our means, at least on our part, we do have a portfolio of both new and older properties, and I think the older properties is where we can potentially look for value add by going through master planning together with, for example, our neighbor, or if need be even on our own, to then seek a new vision for that area, for the property, and in the process get approval for a higher plot ratio, more GFA, that we can either then recycle back to our sponsor at a higher value than what we acquired, or even divest it in the market, which is what we've done for Central Square. So as an example, for Central Square, I mean, it was in an area that was not really doing very well. It was actually getting worse than the vision that was envisioned when the piece of land was tendered out by the government. So it didn't actually come about in terms of how it was intended to be. So together with our neighbor CDL, then we came out with a master plan, put up the proposal to URA, and we managed to get a 78% increase in GFA. And as a result, we were able to divest it, with a very nice profit, which is also about 80% higher than what we acquired for. So I think this value add, I'm not sure you call it innovation, but things that we can look at, especially to look for gems within our portfolio to see what we can do to create value for unit holders. So yeah, so we have gotten one done, and then we are also looking at some of our older properties whether we could do the same, rather than just a straightforward just buy, hold, and sell. And we try to value add before we do any kind of divestment. Otherwise, we just hold the property.
Yeah, thanks. So in a nutshell, there's property development optionality, I guess, or upside to most of your well-located assets. Okay, let me move on to the next question for Kelvin. This is how is tenant sales at 313 and GEM versus pre-COVID? Any plans to increase 313 plot ratio from the 4.9 plus, or how you got that number, to 5.6, resulting in potential increase of up to 1008 square, or did a lot of homework to up to 1008 square meter of space?
Yeah, okay. I think thanks for the very relevant question, and obviously I think this is a person that actually follow us very closely. I think that's what we want to cultivate and continue to give them the right information so that they can actually follow up with us with a right mindset. Okay, I think the sales number and on 313 and GEM, as I have sort of elaborated earlier, is that it's already exceeding pre-COVID easily by over 20%. So what it means is that we will be able to actually potentially have a very positive rental reversion momentums going forward to increase, of course, the rental chargeable, at the same time increase our net cash flow distributable to the unit holders. I think as he has rightly pointed out, is that 4.9 is the initial plot ratios that we have. I think subsequently, as soon as we acquired 313, the government actually increased our plot ratio to 5.6. That's when actually we have this additional plot ratio to be deployed. So what it means is that without paying any money, unit holder or without paying any money, this is additional space awarded to us that we can sort of like deploy and make it a cash flow generating space that we can distribute to the unit holders. So what we do is that, of course, during the COVID, when the business is a bit disrupted by the COVID issue, so in the case there's not we are not actually looking at that first, because it's more to stabilize the business, to stabilize the cash flow. But I think since now COVID is behind us, and I think everyone is looking forward, we are actually having some plans to sort of deploy this balance additional port ratios, which that will means that unit holder will soon, once we deploy and we get the space listed out, will be able to enjoy a higher cash flow from the portfolio that we have. Yes, this is already in our plan, and certainly at the right juncture, we will certainly inform the unit holders appropriately. But at this moment, we are still planning, because we want to fully utilize the space to see which are the best locations to unlock the best values for the unit holders. And sometimes getting it deployed is the best way to unlock values. But sometimes it could also be a space that on the first floor that actually can charge higher rental will also be the best way. We have to see some of this renewal momentum at the same time, where's the best area. But I will not forget to actually use this, and I will use it as soon as possible so that unit holders will enjoy the uplift of the cash flow.
Thanks for that, Kelvin. I'll move on to the next one. Is for Gerald. Given that we are all used to Zoom meetings, does Far East not expect a fall in corporate travels? I mean, just to add, I guess not, because you're like record room rates and record occupancy, but maybe in the medium term, if maybe you could throw that perspective. Yeah.
Sure. I think tools like Zoom and Teams, etc., is a great productivity improvement in helping people to connect, to share information, save time rather than traveling from one place to another. So even today, I had a Teams meeting rather than spending half an hour to travel there and half an hour to get back. I think this is great. For corporate travel, I will say that there are many different types of purposes in terms of corporate traveling and different types of corporate business. For example, the kind of corporate business that will not be impacted by Zoom will be, for example, project groups, which we get quite a lot. Project groups that are here because they are working on some engineering issue or could be even some infrastructure project for the government. They are specialists that are deployed to Singapore for some purpose, because we don't have such manpower. There could be Australians coming to help to dig the tunnel for MRT, etc. So this is one type of project group which we get quite a lot, and they are staying in our service residences in our hotels. Another group, for example, would be people who are on ship. They are passing by Singapore. They need the ship need to be upgraded, repaired, or stock up. The crew need to refresh themselves, take a few days leave. So we also get that kind of business, for example. And then corporate groups, they are here for training, to attend events, etc. The events are meant for people to interact, to see each other, and that includes conferences, whereby they need to see people face to face, shake hands, and either do business or just be updated, whatever's the latest. So I would say that maybe Zoom may affect the more discretionary kind of individual corporate travelers who in the past, maybe people just flying here and there, just say hi and so on. But even so, there's some value for business travel to allow people to connect and just have a good feel whether this is a business partner we are working with, or just to spend time to build up the relationship. Which is why I think the last quarter of 2022, there was a big surge in corporate travel as soon as we opened up the gates. So despite Zoom being so prevalent during the COVID people, whereby people are communicating using Zoom or Teams, etc. But as soon as they were able to travel and where the flights resume, you see a big rush of people coming back for all kinds of business-related purposes. So I would say that there might be some impact whereby the more discretionary kind, whereby people are just going to their corporate office for some meetings, I think yes, there'll be some impact. But by and large, I think in terms of the pattern, in terms of the way of doing business, unlikely that a huge proportion of corporate business will be displaced by such tools. That's my view, even going into the medium term, unless there's some other alternative solution that can solve some of the other objective of why people are traveling in the first place.
Thanks so much, Gerald. Let me just move on to the next question. It's addressed for Kelvin. So would Lendlease consider divesting Sky Complex Milan, especially at the current interest rate reset on your perpetual bond coupons could be high?
Okay, I think this is a very interesting question, and of course, I think never say never, because we always consider a wholesale analysis to see what is the best proposition for our portfolio. And perhaps I think might want to share a little bit more on this Milan asset, so that I think everyone will have some kind of understanding why actually this asset is in the portfolio. I mean, first of all, this asset, of course, is a AAA. It's a Grade A freehold properties. I think it's fully leased to tenants called Sky Italia, and Sky Italia is 100% owned by Comcast, and Comcast is the world #1 in terms of revenue in the broadcasting industry. So in the case, they are #1, and they are actually probably AAA rated, which the rating is even better compared to the country of Italy itself. So I would say it's a very good rated tenant, and basically is long lease expiry on 2032. Of course, there's a break clause on 2026, but we don't think they will break, because I think they have invested a lot on the properties, and also if they break, they have to break the three buildings itself once in the case. But they have, it's very difficult to actually move people around in Europe countries, and you need to pay a lot of compensations to do that. So all these, and their rental rate is actually quite below market, which means technically the stickiness is that they are very sticky to the properties. So that also, I think the other thing that I want to emphasize is that this has an annual escalation, and the annual escalation is pegged to the CPI index. And if, as you rightly know, that the CPI index will go up because of inflation, likewise is our rental collection from this tenant itself. And so far, this tenant is a very good tenant, and this is a tenant that actually continue to pay us rent even during the COVID, because they are operating essential services. So I think they are good. I mean, they are not disrupted. So it's a triple net. So, and every time the rental, as it grow, as it move up because of CPI every year, that will become a floor. That means if let's say CPI is a negative, it will not go down. It's a ratchet kind of arrangement. So we only go positive, but it will not go down. So in that case, the rental will keep going up. But how about the cost? Actually, it's a triple net. As I said, it's a triple net lease. So you would not have any kind of impact even when the inflations keep going up and kind of things, because the tenant will take care of the cost itself. So we actually is on a win-win situations. When the inflations come, we actually enjoy a higher rental from this tenant while we are not suffering from the cost. I think, having said that, I mean, it doesn't mean that we will not divest. I think what we do is that as long as we feel that there's a good opportunity, we already maximize the values, there's not much we can do to actually improve on the valuations. Perhaps we could actually use to divest. We will actually divest it and maybe take back the cash, as what Gerald has done for his properties, and then see how we can sort of redeploy it or maybe distribute to the unit holders. That's why we actually believe that we shouldn't fully hedge our interest rate position, is because we want to have the flexibility, and having not fully hedged means that we have, if you were to divest, we will not have a lot of unwinding costs on the loan and unwinding costs on the hedges. I think that is the most important thing. So I think to answer this question in a more direct way, yes, I think we could do so. but all have to go through a thorough assessment to see whether we really maximize the values that we have on this asset before we do so. I think basically at this moment the tenant is still strong. I think the cash flow is still healthy, and we can still kind of see how we can sort of continue to grow on the revenue from that perspective for the distribution. Yeah.
Thanks for that. I think in view of time, I esteemed guests, I think I do not want to hold them back too much. So let me just take two more questions and then we just go to closing remarks. I know there's still lots of questions, so apologize for that. I'll just go to the most upvoted, and Kelvin, sorry, I think yours was the most upvoted. Is another question on Lendlease. Lendlease is supposed to do another round of fundraising post-jam, and the share price has been fairly depressed recently. How is this delay affecting the fundraising strategy and future acquisition and enhancement plans?
I think first of all, we are not going to do any kind of fundraising already, because what we do is that we already raised sufficient fund for jam. Hopefully, this is not one of the several reasons why the share price was depressed. I think, to be honest, we feel that the share price shouldn't be trading at this range. I think it's really, we need to actually sort of let more retail investors know about us and understand our REIT and know how stable is the REIT, so that in that case they will not have the misperception. And this likely will be one of the misperception that we want to do another fundraising. But we are honestly already done all our fundraising already, so that was not necessary. So yeah, hopefully this answers the question.
Okay, yeah, thanks for that. So that's a no, basically, to make sure everybody got it. Sorry, I'll just move on to the next most upvoted, handing over to Gerald, and also Ben and Kelvin, because it's about consider a share buyback. So with both Far East and Lendlease trading below NAV, would you all consider a share buyback mandate? I'll hand it over to you, Gerald.
Yeah, for us, because we distribute all our available income, pretty much not except for the COVID period where we kind of like spread from one half to the other half. But every year we've been distributing all the available income to unit holders. So we do not hold cash just like a normal listed company, whereby maybe the distribution policy is 1/3 of the profit that they are sitting on a pile of cash that they can use it to buy back shares. So for us, to buy back means you have to borrow from a bank, which doesn't really make sense for us. And where we do get divestment gains, like in the case of what we've done, then we can share some of these gains with unit holders, which hopefully will be appreciated. That can then help us to bridge the gap between our share price and NAV. So I think definitely our share price has been affected, partly due to COVID, and also the fact that maybe it's not been fully appreciated by investors, given the value of our assets, which is why the NAV is high. For example, we're able to get a $100 million gain in terms of the fair value of property last year, which is a 1.5% increase, which means that the valuers still see good value, and that we are able to get a gain that helps to increase the NAV, which then at some point we hope that the share price would catch up when investors see continual improvement in terms of the underlying performance of properties and whatever gains that we're prepared to share as well.
Actually, when you enjoy a huge disposal gain, because your assets are already marked to market and you still enjoy a huge disposal gain, so it's either you sack the valuer or there's another use to it. That means you sold it on, like you mentioned earlier, it's a development potential. That's why you got this huge gain, I guess. Is it one fair way to kind of understand the
gain? Okay, just to qualify, the gain, $100 million gain is apple to apple. That means it's for the same properties, excluding what we have already sold off. So for the remaining assets. So then, of course, if we add the divestment gain of another $130 million, so effectively it's almost a $230 million increase in value of the same assets.
Okay, got it. Thanks. So I'll just hand it to Kelvin on just our last question again, just on the share buyback mandate, and then we can move on to closing remarks. Yeah. Thanks, Kelvin.
Yeah, I think very similar to Gerald is that we also fully distribute what we can, to the unit holder, and so far it's 100% distribution throughout the years that we have listed. So of course the balance sheet means that the balance sheet don't have a lot of cash, Of course, the only possible for us to do any buyback is like what Gerald has been doing, is that they sold some of the asset, they have some cash available. Of course, if let's say it's not going to actually reinvest, I think that is one of the options that we can actually choose to sort of return to the unit holder as it is. But at this moment, of course, we don't have any kind of divestment cash. The balance sheet cash is low, so in that case we will not consider for the time being. But of course, when opportunity comes, we will certainly consider that.
So I think that comes to the end of our webinar. But before that, I think we just want to have some closing remarks, if there's any. Now, I'll hand it over to you, Gerald. Any then to Kelvin, if there's any closing remarks for some of the attendees that are still here with us.
Okay, thanks, Paul. Yeah, for us, I would say that just to reiterate that we have gone through the worst in terms of the operating environment. At the depth of the situation, we are relying pretty much on the fixed rent in our properties, which in normal times would have contributed about 60%. So in our portfolio, we have about 60% in the pre-COVID days, 60% contribution from fixed rent, another 20% from variable rent, and another 20% from the rental of our retail and office spaces found within our properties. So last year, we managed to inch up about 5% improvement, 5% contribution from the variable rent, which is still some way from 20% mark that we used to generate. So hopefully this year, that will be a further increase with more properties now able to perform above the fixed rent level. So I'll say that for investors who have stayed on with us, we really want to thank them to see us through this period, and we hope to be able to deliver better results for this year and for the year ahead, which we hope to see further improvement in terms of operating environment.
Thanks, Gerald. Over to you, Kelvin. Any closing remarks, if any?
Yeah, Gerald, by the way, I'm one of your unit holders.
Yeah, likewise. I also own some of your units.
Yeah. I think the REIT, the REIT is pretty simple. I think we just listed 2 years or 3 years ago. I think what we do is that while interest rate environment continue to go higher, but I think it will soon be slowed down and even actually probably at a stop eventually. But I think what we should focus is not really on the interest rate, although interest rate is something that is going to cause issues to the distribution, but focus on how the operators or the fund managers continue to generate positive cash flow to the portfolios and continue to enhance their asset eventually to actually even outbid the interest rate and all those things, which that means that higher distribution will go forward for you going forward. And for us, I think that we really have a lot of levers that we believe they can actually increase on the distribution. I think one of it is, as mentioned, is that the sales has actually improved by 20%, ops cost lower. There's been our renewal momentum certainly be going higher, and certainly that will improve on our revenue generation, because that is a top line number, and the increase will certainly be able to sort of manage the increase of the interest rate. Also, as I mentioned, the inbuilt kind of rental escalation that we have, that is also a stabilizer. And we see a opportunity for us to unlock some of this space that in GEM that we can sort of create more values. Likewise, we haven't deployed our 313 additional plot ratio. That is around 10,000 over square feet, which then I believe that will certainly increase on the distribution once we deploy it. I think the future potential of the asset that we have is strong. And also, as long as we manage the revenue well, as long as we also manage the cost well, I think that is when we can actually have a good kind of ways to sort of improve or really stabilize our returns. So unit holders need to actually understand us more. I think instead of just speculating, and sometimes they don't understand, but they feel that the interest rate become always a problem. Actually, it will be a problem for someone that without solutions. But I think for us, we always think of ways to sort of address the issues. So I think for us, it's opportunity for us to create values for the unit holders. I think that's what we've been always thinking, even in difficult circumstances, and we've proven that we are right. I think also, given that we have this GEM acquisitions which we did last year, I think there's a lot of potential for us to sort of lift up the distribution going forward.
Okay, thanks so much, Kevin. So this comes to the conclusion to our webinar. I'd like to thank all the attendees. I'd like to thank our two distinguished guests, Mr. Gerald Lee and also Mr. Kelvin Chow, for spending their time with us, almost more than 1.5 hours sitting down here speaking to us, especially up to 8:30. So with that, I'd like to thank everyone and wish everyone to have a good week ahead. Thank you, everybody.
Thank you, Paul. Thank you, Kevin.
Thanks. Thank you.
Thank you.
Bye, everyone.
Bye.
Thanks, bye.
Bye.